This week, Americans are rating their 401ks at an unprecedented rate, but older homeowners do have this option.
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Welcome back to the Industry Leader Update. The data is in. More Americans are now rating their 401k accounts because of financial difficulties, reports CNN. The most recent report from Bank of America released this month shows that hardship withdrawals from 401ks have increased by 36% in Q1 of this year when compared to Q2 of 2022. That data was drawn, by the way, from Bank of America's analysis of their own clients' employee benefits programs, which includes over 4 million plan participants. Hardship withdrawals can be taken for a variety of reasons, including purchasing a home, paying for educational expenses for yourself or a loved one, medical costs, or to avoid foreclosure or eviction, just to name a few. And the IRS defines a retirement plan hardship withdrawal as a distribution from a participant's elective deferral account made because of an immediate and heavy financial need, and limited to the amount necessary to satisfy that financial need. That money is taxed to the participant and is not paid back to the borrower's account. Keep in mind that not all 401k plans do include a hardship withdrawal provision. But even worse, these withdrawals cannot be repaid, such as a loan. And that means that the plan participant in taking that withdrawal has permanently reduced their account's future earning potential. In part, hardship withdrawals we're seeing today are being fueled by inflation. As the cost of living surges, consumers may opt to charge everyday expenses they once paid in cash to 401k withdrawals or credit cards. Now, the New York Federal Reserve data shows that since 2019, overall household holdings in debt have increased by $3 trillion, while credit card debt alone has exceeded $1 trillion for the first time. Consequently, younger workers are likely to find themselves being cash poor and hopefully house rich by the time they reach their 60s. But what about the older American? That is in fact our concern. Many of them have increased their systemic withdrawals from their retirement savings to help deal with the impacts of inflation. Now that substantially decreases the duration of their sustainable withdrawals, or just how long their retirement money will last. Now others have chosen to work longer or continue to save and hope that the markets will be kind to their portfolio. While this financial drama does play out, millions of older Americans are now sitting on, more precisely, living in a substantial sum of home equity. So why do so few choose to even consider a reverse mortgage? One reason is that many believe that they will be able to tap into their home's value or equity at some time in the future, should they need it. However, that strategy is risky at best. Lenders and banks routinely tighten their credit underwriting standards to consumers when economic conditions are uncertain and especially negative. Imagine the frustration when they learn that the value of their home is stuck in the bricks and mortar of their house and they can't get to it unless they choose to sell. And despite what history has taught us, this is hard to believe, most homeowners today have conveniently forgot that their home's value could drop, even significantly. So how much of their home's equity would be left then? So what can reverse mortgage professionals such as yourself do? Well, one is to understand the basic mechanics of retirement, such as sustainable withdrawal, the accumulation and distribution phases, required minimum distributions, and of course, common pension benefits for surviving partners and what those benefits are. Another key takeaway is to broach the question of just how long their money will likely last. Now, some simple math can tell you roughly how long their current monthly distributions are sustainable, but you don't want to give financial advice, but you also don't want to ignore the elephant that's in the room. Even better, you can partner with a financial professional in your local market who knows these metrics and concepts better than anyone, and they're also very well versed in approaching these very sensitive financial discussions. Now, there's no denying that American retirement is in complete disarray. The question is, when will the largest asset be considered, as a potential source of much needed cash flow. What are your thoughts? You can leave your comments in the comment section below, and if you'd be so kind as to share this week's video, I see a number of you doing that. Thank you, especially on LinkedIn. Don't forget we have a YouTube channel where you can subscribe and hit the notification bell. That way you know when any episode has just been released, and you can catch up on your reverse mortgage news with HECM World Weekly, the nation's only weekly podcast for reverse mortgage professionals, which is now, by the way, on Spotify. And yes, we're still on iTunes where you can listen and subscribe, and Podbean. Thanks again for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis here at HECM World.